Most people think of investing in alternatives as an investment decision. You pick the right deal, you find the right sponsor, you evaluate and underwrite the deal itself, and you pick the return profile. And yes, that is definitely part of it. But before any of that, alternatives are a lifestyle decision because the capital you're putting away in a private deal didn't appear out of nowhere. It came from somewhere. And in most cases, what it came from is a choice not to spend it on something else. That trade-off is real and it's massive. And most content about alternative investments skips right past it. This video is entirely about the trade-off, what you're actually giving up and what you're buying, and why getting that framing right changes everything about how you evaluate these investments and your overall thesis around them. There's a pattern that plays out for most high earners. Income goes up, and in turn, lifestyle directly follows it. You get a nicer apartment, you get a better car, you go on fancier vacations, you go to nicer restaurants, the wardrobe changes, right? The baseline of what feels normal, that keeps going up. And again, none of that is wrong. Those things are real. They feel good. You feel like you've earned them. And honestly, you have. But there's a version of that path where every dollar of increased income gets absorbed directly into that lifestyle. And the person at the end of the path, 10, 15, 20 years later, they have a great life on paper and very little optionality. They need to keep making income to continue living this life. They need this year to work out. They need the next deal, the next client, the next bonus, right? Because that lifestyle has expanded to the point where they require all of it to go back into it. That's what lifestyle creep is. And it's not a moral failure. It's just a default. It's what happens when no one makes a different decision to avoid this path. When I first started putting capital into alternatives, private real estate, private credit, private equity type deals, locked up structures with 5, 7, 10-year hold periods, the trade-off wasn't some abstract idea. That money could have gone somewhere else. And I want to be honest about that. It could have upgraded something, made life more comfortable in ways that I would have felt immediately. The version of that dollar that went into the deal was a version that did not go into the lifestyle. And for a period of time, that is a real cost. You're not just giving up liquidity. You're giving up the immediate gratification of spending that money on something that is truly tangible today. Most content about alternatives talks about the lockup as some technical constraint, 5 to 7 year hold period, right? Limited redemptions, illiquid by nature. But the real version of that constraint is much more personal when you think about it. It's the car you didn't buy, the renovation you pushed off on your house, the version of your life that you didn't upgrade just yet, because that capital was deployed. And that was deployed somewhere else into a deal that you won't see benefits from for likely years. I think it's important to name that honestly before we talk about what you get in exchange. Because if you don't understand what you're actually giving up, you cannot properly value what is they're getting as a trade-off. So now let's talk about what you're getting as that trade-off. The obvious answer is yields, returns, distributions, right? And yes, that is real. But I want to go one step deeper because I think the yield is actually the second best thing you're buying when you invest in alternatives. The best thing you're buying is runway. And let me explain what I mean by that. When your capital is deployed into assets that generate income without requiring your time, when you have distributions coming in that aren't tied to how hard you worked last month, you start making decisions differently as it relates to your life. Not because you're wealthy in some abstract sense, but because you need every single thing to work out perfectly. You now have margin you're building into your life. You can pass the wrong opportunity because you're not desperate for the next one. You can think about a 2 or 3 year horizon instead of just the next month, next quarter, next paycheck. You can take a more concentrated risk instead of a pressured one. That's runway, and it's generally hard to put a number on it, but it changes every quality of the decision that you're making, right? The liquidity premium you earn in alternatives, the extra yield you get specifically because the capital is locked up, that's real and it compounds. But the optionality you build underneath your life by not letting your lifestyle absorb every single dollar that you earn, that compounds differently. And in some ways, it's actually more important too. Once you understand this framing, the way you think about evaluating alternative investments entirely shifts. Most investors come to a deal asking, what's the return? What are projections? What's the IRR? What's the multiple I'm getting, right? What's the cash on cash return? And those are definitely the right questions eventually. But the first question should be, can I genuinely afford to lock this capital up for this period of time? Not just technically, not just, yes, this is money I don't need next month, but deeply, right? Think about it on a personal level. If this deal goes sideways, if distributions are delayed, paused, if the period extends, if the capital is locked up for longer than I planned, does it change how I live? Does it change the decisions I'm able to make? Does this affect me mentally to a point where my life is put on pause? Does it pressure other parts of my life financially? If the answer to any of those questions is yes, the yield doesn't matter just yet because you're not actually in a position to pay the real price of this investment. The investors I've watched navigate alternatives really well across many deals over a long period of time, they treat illiquidity as a feature, not as a constraint due to the deal. They deploy capital they genuinely have set aside strictly for this purpose. They don't check the performance every quarter, right? Hoping for an early distribution. They let the capital do the work and sit there. And what patience actually reflects isn't just discipline. It's what they built. And that they built enough runway underneath themselves to allow that lockup period to not create pressure anywhere else in their life. That's the foundation they've built and they've earned. Before you evaluate a single deal, that's what has to be in place. And alternatives are a powerful part of a well-constructed portfolio. I've invested in nearly 100 private deals, and what I've seen as a consistent, patient deployment of capital into the right structure can do over a long period of time. But the investors who get the most out of these structures aren't the ones who found the best deals. They're the ones with the right foundation first to allow themselves the runway to do things the right way. They made a different decision than the default. They let their lifestyle absorb every single dollar they had. They built optionality underneath themselves, and then they deployed that optionality into assets that compounded it further. That's the real cost of investing in alternatives, and it's also the real return. Most people never make that true connection. The ones who do build something that is very different and very sustainable. If you want to understand how all that plays out across specific asset classes, subscribe to this channel. We cover it in depth every single week. Thanks for watching. We'll see you next time.